Welcome back to CMG Forex lessons. This is the masterclass on Candlestick Patterns. And we are at the moment on trading the engulfing bar with moving averages. Right? We have done a number of them. We have done the pin bar trading, and now we are on engulfing. Right? With the pin bar, we saw a number of them, the strategies that we could actually trade. And we have done that. Now, at the moment, we are going to do the engulfing bar. And this time, we are going to do that with the moving averages. I know you have not really explained or dealt with moving averages. So this is on the lighter side, right? So just take it as the introduction. So with time, we'll get to understand them more. So that is it. Now, trading the engulfing bar trading engulfing bar pattern with moving averages provide a very profitable trading strategy. However, the lack of knowledge about using the moving average can damage dramatically your trading account, in fact, drastically. So, traders are using moving averages in different ways, right? Moving averages in different ways. In fact, before we continue, moving average is what? It's a technical indicator. It means it's something that you don't actually draw it on your chart. You don't do the markings on your chart. It's a matter of just going to select that indicator and then doing some settings. The only manipulation that you can actually do on this indicator is to make some changes as in settings, right? We have a number of them, 50, 200, 150, in fact 20 and all that. So it depends on what you are going to use that one for. And each of the numbers can actually play a role in what you intend to see or anticipate in the future. So that is it. Now, as a trend following through to identify the direction of the trend, so they buy the market when prices are above the 20 simple moving average, right? We have 20, we have the 200, this 200 rather. I told you we have a number of them, right? So we are going to use the 200, right? And they sell the market when it is below the 200 simple moving averages. And in fact, with the moving averages, we have different types. We have the simple, we have the weighted one, we have the exponential one, right? So as trader, in fact, as a beginner, we are going to stick with a simple one. We don't want any complex things on our charts. Like I told you from the onset that whatever we are going to do here, we are going to keep it simple, right? So you think you can't deal with simple things, then I beg to differ. Maybe you have to wait for the advanced lesson and then we can move on with that. But if you're an amateur and then you are an intermediate forex trader, this is the best video for you, right? So we are going to stick to the simple items, right? So even the 200 moving averages, the one that we are going to use is a simple one. And then the what is stating here is as simple as that we are going to use the 200. If prices move above the 200, what do? We are going to buy. If you move below, we are just going to sell. It's as simple as that, right? Now, to determine whether the market is overbought or oversold, we just watch how prices interact with the moving averages. For example, in an uptrend, if prices move far from the moving averages, it means that if prices move far away from the moving averages, this is an indication that the market is overbought, right? So we are saying that if prices move above, we are going to We are going to buy, right? If prices are above the moving average, the 200 moving average, we are going to buy. And if it's below, we are going to sell. But if the price move further, very far away from the moving average, then what it means is that the prices are that particular currency is bought, right? Now, to predict the trend, change by using the crossover strategy. if the moving average crosses over another, it is a signal of trend reversal, right? So we are going to use a simple one. Initially, we are going to use 1, and then with time, we are going to use 2. So whereby the 2 crosses, then we know that if the trend was actually moving in one direction, now after the crossing, there's a higher probability that the prices are going to move in the reverse direction. So that is what it means. Now, as any trading system, the moving averages have disadvantages. This is why you have to know how to use it successfully under the right market conditions. Every tool, if you don't use it well, in fact, if you don't know how to use them well, it will be to your disadvantage, right? So you make sure you master a particular technical indicator before you actually begin to use it. Because if you don't have the ins and outs of that particular indicator, it will be very dangerous to your trading account. Now, this trading technical tools doesn't apply to all markets. You don't need to try to use it in range. You don't have to use it in a range band or on tradable markets, right? So what it means is that this particular tool, as the moving average, don't use it in a range bound market. It means a consolidating market. You don't use the moving average, right? Because you will not actually see the direction of that. The direction is just limited to some boundary, some channel. So it is not the best tool or indicator to use. That's what the book is saying, right? So don't worry yourself. Don't even put it on your chart. If you have it already on the chart, then when it gets to that side, when you see the consolidating market, you don't take trade on that that area or at that point in time. So that is what it means. Now, because you will get a lot of false signals, and you will definitively blow up your account, your trading account. To be the best of my knowledge, using the moving average as a dynamic support and resistance in trading markets, in combination with an engulfing bar pattern signal, is the best way to make money in the market, right? So I think let me take it again. To the best of my knowledge, using the moving average as a dynamic support and resistance in the trading markets, in fact, that's what you have to use. So to the best of his knowledge, you have to use the moving average as dynamic support and resistance. It's similar to whatever we have treated earlier. And then in combination in combination with the engulfing bar pattern signal. So that is that means we are talking about confluence, right? You use the dynamic moving averages, the support as the support and resistance, right? In conjunction with your engulfing candlestick patterns, right? Because the main aim of this particular video is to trade the engulfing bars with the moving average. So that's what we are looking at. Now, the strategy is very simple. We will use the 21 and the 8 simple moving averages in the daily and 4-hour time frames. We will define a clear bullish or bearish market, and we will simply buy when price pushes back to the moving average and an engulfing pattern forms. So that's what you have to look at. Initially, if you remember from the previous video, we were doing the pin bars, right? With the resistance, the support, and the dynamic, the support and resistance. That was what we were doing for the pin bar. So that was another a strategy. So someone may stick to only trading the pin bars, right? Everything concerning the pin bar, that's what they would trade. That's the only thing they would trade. And then another person can also stick to the the engulfing bars, right, with other confluence. So this is another strategy. So you will decide which one works best for you. So that is it. Now, this is an example. We have a general uptrend, right? And then in this market, it means we cannot draw a straight trend line. trend lines should always be drawn in a straight line, right? And this particular matter, if you try to draw a straight line, you may not get the direction of the market very properly, right? So we use another indicator called what? The moving average as a dynamic what supports a resistance, right? And these are the moving averages. We have the 8 and we have the what? The 21 moving average, right? So that is now and then we have the engulfing bar what's forming. This is a bullish engulfing bar in the bullish what direction. So let's see if we can actually what buy as we already have beforehand. We already know about this pattern formation, right? So let's continue now. Conversely, if the moving average is trending down, it shows that the market is in a downtrend, right? Conversely, if the moving average is trending down, it shows that the market is in a downtrend. We will sell. In fact, we sell when the price retraces to the moving average, right? It's like the retracement that we did in the pin bar. So if you have actually watched the pin bar trading strategy, I think this one will be very easy for you, right? So please make sure you always watch the previous videos or the recent video before moving towards the next one. That is going to help you a lot, right? So that is it. So we are training the engulfing bars with the dynamic support and resistance, right? With the help of what? A retracement, right? When they pull back to that particular dynamics support and resistance, when we can actually take our trade, whether we are going to buy or we are going to sell, depending on the general direction of the market. So that is what we are looking at now. The screenshot below shows how prices interact with the moving average as dynamic resistance level. And the engulfing bar pattern represented a high what? Probability. I'm going to take it again. The below shows how prices interact with the moving averages as dynamic resistance level, and how the engulfing bar pattern represented a high probability setup. So this is where we are. So generally, like I said, when you open your chart, anytime you open your chart, you have a general idea of the market structure. And what the market structure means is the market moving up generally or moving down. Is it consolidating or is it what? Choppy? So after deciding that on that, then you move to what? Your support and resistance, right? Where you can actually draw your support and resistance levels. If you cannot draw your support and resistance level in a straight line, horizontally, then you have to what? Look at what? A trend line. Could that trend line also be drawn in a straight line? If that cannot be drawn in a straight line, then the last alternative is to what? Use your dynamic what? Support and resistance level. And these are the what? The moving averages, right? The 21 and then the 8. So, right. So generally, this is what? A downtrend. So the downtrend, what the first impression that you should have is that you can actually what? Buy. You can or you may buy, right? Upon doing your what? Your confluence, checking other factors, if they are okay. So this is a general downtrend, right? That's one factor. Then you look at your trend lines, right? The trend lines with these are the dynamic one, the 21 and then the 8, right? So generally, this is moving down. Now, when we got to this point, what did you do? You waited for the price to trace back to what? To the support level. Now, when it traced back, lo and behold, what actually formed there? There was what? An engulfing bar forming there. So that also gives us what? The third what? Factor to our confluence. So it means that we can actually what? Sell around this place, put our SL here, and then put our TP. It's as simple as that. Let me clean this out. You can have a better look at this. So that is it. This is actually what? Bearish engulfing. The two candlesticks here, bearish engulfing. So you can actually what? Buy. It's as simple as that. Now, let's okay. I think we can continue with this. Now, we are going to also continue with how to trade the engulfing bar with Fibonacci retracement. This is simple. It's as simple as what we have just looked at, right? It's a matter of dealing with the percentage, the 50 and then the 61, right? Pricing retracing to that point, and then boom, you decide to buy or you sell, depending on the general direction of the market. This is as simple as that. Now, traders use Fibonacci retracement in different ways. However, the most important Fibonacci retracement levels are the 50% and then the 61%, right? It means that we have different percentages. But what actually works mostly is the 50% and then the 61. When prices retrace to these areas, then we can we call it as a retracement, right? So when there's a retracement, prices will move back in the opposite direction. So that is what it means. Fibonacci retracements, knowing how to use this tool in conjunction with Japanese candlestick would definitely, right? Forget about this. Sometimes this is the problem why my reading is a bit bad. You might read it as it is, then later realize grammatically it's wrong. So Fibonacci retracement, knowing how to use this tool in conjunction with Japanese candlestick will definitely maximize the profit potential. According to chart technicians, the major moves, retrace around 50% or 61% Fibonacci retracement, right? Now, this knowledge will provide you with the ability to predict with high accuracy the next major move in a trending market. The strategy is very simple. You define a clear uptrend or downtrend, and then you define major corrective levels by using Fib retracement tool. If you see an engulfing pattern, right, engulfing bar pattern matches up with 50% or the 60% levels, it is a powerful price action trading signal. Yes. So let's see an example below. This is a general uptrend, right? Prices are moving up generally, right? This way comes here, this way comes here, this way. Now, we assuming this is our resistance level, because price were moving initially below it. Then until price broke out of it, this resistance, this red line. So when price broke out of it, we waited for the price to actually retrace back to the same level. Because the idea is that in this market, prices do not move in a linear sequence, in a straight line. They move up, down, in that sequence, even though prices are generally moving up, right? So that is it. So you wait for it to trace back to a point. Now, when we trace back to this resistance level, which has now become our support because price has moved above it. So the moment they move above it, this initial level names becomes different. So this is where it is. I think I didn't even see it. So resistance becomes support, right? Good. Thank God the point that I was trying to arrive at is here. So what do? Price move up, you wait for it to retrace back to that same line. Now, when you move back to the same line, you don't have to rush into it. You wait for another confluence, which is very important in this strategy. And that is the bullish engulfing. This is a bullish engulfing, the one in the green box. The one in this pattern, the green box is the engulfing pattern. Please, if you have forgotten about this, please go back. The previous videos, I think episode 4, and then look at that pattern. After knowing that pattern, actually trade it. If you don't know the pattern, you can't trade it, because knowing the pattern and trading are different, right? You can know the pattern all right, but you may not be able to trade it because you don't have that strategy. So after learning that pattern, you come back to the trading, the strategy, and you can actually implement that. So this is very important. So now, when you move back to this line, right, you move back to this line. Meanwhile, there's another factor the fourth factor, which is the Fib, right? We have the first one, pricing moving generally up. That's one factor. We have our support and resistance. That's two. We have a pattern forming back to that resistance line, on which is now our support. 3. And then finally, the fourth point is what? The Fib. So these are what? Our factors of confluence. You can never trade properly without what? Confluence. Right? So you always take into consideration these things. That is important. So with the Fib, we realize that now 50 is around this point, right? And then the 61 is around this point also. So what we realize is that the price moved to this area. So normally when price move between this area, in fact, from 50 to the 61, moving between these areas, around this area, you can actually what? Take your trade. You can decide and take your trade. That is what it means. It's as simple as that. Now, in the example above, the engulfing bar price action signal matches up with the 50% and 61% Fib level. The resistance level that becomes support is another confirmation to take this what? High probability setup. This strategy is very powerful. Here is another example below that illustrates the 50% and 60% of the Fib. So when we come, first you open your chart, you look at what? The market structure. One is what? The price is generally moving what? Downward, right? We have pricing moving generally downward. Higher lows and lower lows, right? You should know that. If you don't remember this, go back. So one is what? Prices is what? Moving downwards. So there's a downward trend. Now, two, we draw our what? Our either support or resistance. So if you take prices always start from the left. That's the history of the what? The chart. So you look at the movement of it, then you can decide which line to draw. Is it a resistance or support? Now, when prices are moving down, the line that you draw is actually what? Your support. The first one that you draw. When prices are moving down, your line that you draw is what? Resistance. Bear that in mind. And then when prices are moving up, your line that you draw is your resistance. I think you got this. So this line will be our what? Our resistance. No, it should rather be our support. I hope I didn't get. So let me take it again. When prices are moving down generally, the line that you draw is support, right? When prices are moving down, there's a downtrend. Your line that you can draw, the level that you can draw is what? Support, right? So that is it. And then when they're moving up, the line that you can draw is rather resistance. So I think I've corrected myself. So that is it. So that is the two. We have drawn our what? Our support. Now we realize that when price got here, what did you do? It broke out of this support level. So the moment it breaks out of it, the level now becomes what? Our resistance. That level takes on the opposite leg. It becomes our resistance. Then price moves here. Then realize that price moved back to this level. To what? That's what? There's a retracement, right? Price got here and then moved to this level. So price has retraced back as if it's going to go up. Now, what formed there? The third item to what? To identify is what? The type of pattern. Now, the pattern that we got here is what? Bearish engulfing. This, the one that I've circled, is what? A bearish engulfing. This one, bearish engulfing. The bullish candle, the small body, and then the bearish one, the bigger one, right? So that's what? Engulfing bar. The bearish one for that matter. Now, it formed at the retracement point, right? It formed around the retracement. In fact, it formed around the resistance level, right? The retracement, when it retraced, this pattern formed around what? The support level, right? Which now has become what? The resistance. Now, when it forms there, this pattern is actually what? A bearish type. So if it is bearish, then there's a high probability that price is going to move down, right? So now we have our third what? Factor of confluence. Factor of confluence. That's the 3. Then the final one, the 4th one, is the fact that this retracement happened between the 50 and the 61. So that is another convincing factor to consider. So when this one forms, good, then we take our trade. So after forming this, you can actually take a trade around this place. Your entry can be around this place, right? Your SL can be just about this point. Then your TP can be anywhere around here, depending on your risk to reward ratio. So this is as simple as that. So let's see the description below. Trading the market for 50% the 61 Fib levels means you are trading from better price levels. As a result, you will put as many probabilities in your favor as possible, meaning you are checking all the factors of confluence. And that will allow you to become one of the most successful traders. So I think we can end here and continue in the next chapter. I don't want the videos to be lengthy. So thank you very much for watching this video. Please like and subscribe. And if you have any problem, please get back to us. We also provide private online lessons. Check in our bio, our description, and then get back to us. Thank you very much. Bye.